You open your banking app on a Wednesday evening after dinner, and you see the number sitting there, $11,400. You have been moving money into this account for 2 years, not dramatically, not according to any sophisticated system, just the quiet habit of taking whatever was left after the bills and the groceries and the ordinary costs of a month and moving some of it somewhere it would not get spent. Some months it was $150, some months it was $300. One month you managed $400 and felt genuinely good about yourself for about 4 days before an unexpected car expense arrived and reminded you why you keep a savings account in the first place. $11,400. 2 years of showing up consistently. 2 years of the small choices that add up in ways you cannot feel month to month, but can see clearly when you look at a number that was 0 24 months ago. You feel good about it. You should feel good about it. Most people never get here. Most people spend everything that arrives and tell themselves they will start saving when the situation is slightly better, and the situation is never slightly better because the situation is always exactly as complex as whatever income is available to fill it. You got here. That is real. And then you scroll down in the app and you see the interest earned line, $47. $47 earned in the last 12 months on a balance that averaged somewhere around $8,000 across the year. Not $47 a month, $47 total for the entire year, for 12 months of your money sitting in an account doing the financial equivalent of absolutely nothing, while you did everything right by every standard anyone ever gave you for what responsible money management looks like. You sit with that number for a moment. $47. And something shifts. Not dramatically, not with a revelation or a crisis or a sudden clarity that reorganizes everything, just a quiet awareness that what you have been doing is the beginning of the right thing, and not the whole right thing. That saving and building wealth are not the same process, and that at some point the transition between the two has to happen, and that at some point means something more specific than eventually. That moment for you is now, Wednesday evening, banking app open, $47. Here's the thing that nobody explains clearly when they talk about money, and it is the thing that separates people who accumulate savings from people who build actual financial independence over time. Saving and investing are not the same activity. They are not even the same category of activity. They serve completely different purposes, and they work through completely different mechanisms, and treating them as interchangeable is the single most common reason people who do everything right financially still arrive at 50 with less than they expected to show for decades of discipline.
Saving protects money. That is its entire job. A savings account holds what you put in it and returns it to you intact when you need it. It is not trying to grow anything. It is not attempting to multiply anything. It is a container with a lock on it, and the lock is the point. The money you put in is the money you get back, plus a number so small it is almost rude to call it a return. Investing grows money. That is its entire job. An investment is not a container, it is an engine. You put money into it and the money goes to work, and the work produces more money, and that money goes to work, and over enough time the engine produces outcomes that have almost no relationship to the amount you originally put in, because the compounding has been running long enough that the original contribution is a footnote in the total. Same money, completely different outcomes depending on which process it is inside. Here is what that difference looks like when you run it honestly across 20 years. Your $11,400 sitting in a savings account earning the kind of interest rate that most banks currently offer on standard savings accounts will be worth somewhere around $12,000 in 20 years. You will have earned approximately $600 in interest across 2 decades. The money will be intact, it will be safe, it will be almost exactly where you left it in real terms, and considerably less valuable in purchasing power terms because inflation will have quietly reduced what $11,000 can actually buy. That same $11,400 invested in a broad market index fund and left alone for 20 years, assuming the historical average annual return that the market has delivered across long periods, will be worth somewhere between $70,000 and $80,000. No additional contributions, no active management, no checking it constantly or making decisions about when to buy and when to sell, just leaving the engine running for 20 years and getting out of its way. Same $11,400, same 20 years, $12,000 versus $75,000. That is not a small difference in outcome. That is a different life. That is the difference between arriving at your mid-50s with savings that need to last you a reduced number of years and arriving with assets that have the potential to sustain you indefinitely if you manage them reasonably. The gap between those two outcomes is not created by income. It is not created by intelligence or access to special information or a connection to someone who knows which stocks to pick. It is created entirely by which process your money is inside and how long it has been inside that process. This is the transition. This is what this is about. Not abandoning saving, not replacing caution with recklessness. Moving from a system designed to protect money into a system designed to grow it, and doing it in a way that does not require you to risk what you cannot afford to lose, or understand things that require years of study to use effectively. Here is exactly how that transition works. The first thing you need to understand before you move a single dollar anywhere is what your savings account is actually for. Because the answer is not nothing. The answer is not that savings accounts are useless and the financially sophisticated among us have abandoned them entirely. The answer is specific and important, and getting it wrong is what causes most people to make the transition from saving to investing in a way that eventually sends them running back to savings at exactly the wrong moment. Your savings account is for emergencies. That is it. That is the job. Not opportunity, not the thing you are going to invest eventually, not a temporary holding place until you figure out what to do. Emergencies. 3 to 6 months of your actual living expenses sitting in an account you can access without penalty within a day or two, doing its real job of being available when something goes wrong that you did not plan for.
Most people underestimate this number because they calculate their monthly expenses optimistically. They think about rent and groceries and the regular bills and arrive at a number that is technically accurate for a normal month. An emergency is not a normal month. An emergency is the month your transmission fails and your landlord raises rent and your hours get cut, and all three of those things happen in the same 30-day period, as they sometimes do, because life does not schedule its problems conveniently. Calculate what you actually spend in an uncomfortable month. Multiply it by 4 at minimum. That number stays in savings. It does not move. It does not get invested when you find something that looks promising. It is not available for opportunities. It is the floor your financial life stands on. And without it, the investing process eventually breaks down because you end up needing to pull money out of investments at moments when pulling money out is exactly the wrong thing to do. If your savings account currently holds your emergency fund and nothing else, you are in the right place to begin the transition. If it holds more than your emergency fund, the excess is the money you are going to put to work. The second thing you need to understand is the difference between what saving feels like and what investing feels like, because these are genuinely different emotional experiences, and not understanding the difference before you start is what causes most people to make a decision in month 3 or month 4 that undoes everything the first 2 months built. When your money is in a savings account, it is stable. The number goes up slightly every month and never goes down, and you can check it whenever you want and it will be exactly where you left it. This stability is not an accident. It is the product of an extremely low return. The safety and the low return are the same thing. You are earning almost nothing precisely because the money is going nowhere and doing nothing, and therefore cannot be reduced by anything. When your money is invested in the market, the number moves. It goes up on days when markets are rising and down on days when markets are falling. And sometimes it goes down for weeks or months at a stretch for reasons that have nothing to do with your specific investment or any decision you made. You can check it and find it's worth less than what you put in. This is not a malfunction. This is the investment doing its job. The movement and the long-term growth are the same thing. The fluctuation is the price of the return. You cannot have one without the other. Most people understand this intellectually before they start investing. Almost nobody is fully prepared for what it feels like the first time they open the app and see a number that is lower than what they contributed. The intellectual understanding and the emotional experience of watching your savings temporarily decrease are separated by a significant distance, and crossing that distance requires knowing in advance that the temporary decrease is not a reason to leave. It is a feature of the system you have joined, and it resolves over time in your favor if you do not interrupt it. The most expensive financial decision most beginning investors make is selling during a downturn. Not because they are irrational, because they were not prepared for what the experience of a downturn would actually feel like, and when it arrived, they responded to the feeling rather than the fundamentals. The emergency fund you built in the first stage is what protects against this. When your savings account holds your safety net, you do not need to sell investments to cover an unexpected cost. You use the safety net. The investments stay untouched. The compounding continues without interruption. Now, here's how you actually begin.
You do not need a large amount to start. This is one of the most persistent and damaging myths about investing, and it keeps more people out of the process for more years than almost any other misunderstanding. Many investment platforms allow you to begin with $50 or $100. The amount at the beginning is almost irrelevant. What matters at the beginning is the habit, the automation, the system that removes the decision from the moment of temptation by making the investment happen before you have the opportunity to redirect the money somewhere else. You decide on a percentage, not a dollar amount, a percentage of every paycheck. 10% is a reasonable starting point if your financial situation allows it. 5% is a legitimate starting point if it does not. The percentage matters more than the number because the percentage scales with your income automatically. When your income increases, the investment amount increases with it without requiring you to make a new decision. You automate it. The transfer happens 2 days after every paycheck lands, not at the end of the month after everything else has been handled. 2 days after the paycheck, before the money has had time to become something else. This is not a trick. This is the single most effective structural change you can make to your financial behavior because it removes the decision entirely. The money moves before your brain has formulated an argument for why this particular month is not a great time. You choose something simple. This is where the majority of beginning investors make the mistake that costs them the most across time. They start looking for the investment that will outperform, the stock that is about to move, the sector that is going to have a strong quarter, the strategy that sounds sophisticated enough to justify the effort of learning it. And in the search for the perfect investment, they either delay starting indefinitely, or they invest in something complicated that requires ongoing attention and eventually produces results that trail the simplest available option. A broad market index fund is the simplest available option. It owns a small piece of hundreds or thousands of companies across the entire economy. When the economy grows over time, your investment grows with it. When individual companies fail, they're a small fraction of a large, diversified holding, and the impact on your total is limited. You are not betting on any single company or sector or prediction about what the next year will bring. You are betting on the long-term growth of the economy itself, which over every extended period in history has been an accurate bet. You do not need to understand every company in the fund. You do not need to monitor it constantly. You do not need to make decisions about when to add more or when to reduce your position. You contribute consistently and you leave it alone, and you do not check it when the news is alarming, and you do not celebrate it when the news is favorable, and you let time do the work that only time can do. Here is what that looks like across 2 decades in a real number. You start with whatever portion of your savings exceeds your emergency fund. Add to it every month automatically.
Use $250 a month as an example, because it's a number that is achievable for most people who have reached the point of having savings to transition from. $250 a month invested consistently in a broad market index fund delivering the historical average long-term return over 20 years produces somewhere around $185,000. Your total personal contributions over that period are $60,000. The remaining $125,000 was produced by compound growth, not by you making smart decisions or timing anything correctly or knowing something other investors did not know, by starting and not stopping and leaving the engine running. That is the whole strategy. It's not complicated. It does not require expertise or special access or a financial advisor or hours of research every week. It requires the willingness to begin, the discipline to continue, and the patience to leave something alone during the periods when leaving it alone is uncomfortable. There are going to be months when the market drops and the number in your investment account is lower than it was the previous month, and you are going to feel the pull to do something, to move the money somewhere safer, to pause contributions until things stabilize, to wait and see before continuing. Every one of these impulses is the wrong response, and every one of them is completely understandable. The investors who build real wealth over time are not the ones who never feel those impulses. They are the ones who have built the system in advance so that the impulse arrives after the decision has already been made and automated and made difficult to reverse in a moment of anxiety. The market has dropped significantly multiple times across history. Every time it has eventually recovered and continued higher. The investors who stayed through every downturn participated in every recovery. The investors who sold at the bottom locked in their losses and missed the recovery entirely. Long-term investing is not about avoiding the painful moments. It's about having structured your participation so that the painful moments do not produce irreversible decisions. You are saving. You are doing the right thing. The $47 the account earned last year was not evidence of failure. It was evidence that you had built the foundation correctly and that the foundation is now ready to support something that grows. The transition is not a leap. It's a series of steps that each make sense individually and that together move you from protecting money to growing it. Build the emergency fund and leave it where it is. Take whatever is above that number and begin. Start with something simple. Automate the contribution. Increase the percentage when your income grows. Leave it alone when the news is bad. Look at it occasionally to confirm it is still running, and then close the app and go do something that has nothing to do with finance. The number you are going to see 20 years from now is not built by doing something complicated this month. It's built by doing something simple every month for 240 months in a row without stopping. You opened the banking app on a Wednesday evening. You saw $47. Something shifted. That shift is the whole thing. Everything else is just following through.